An entity tied to JPMorgan's core fund has placed $60 million under contract to acquire our 8-asset industrial portfolio. They have removed all contingencies and posted $3 million in hard earnest money. This data visualization shows deal-level performance, a 31.07% internal rate of return, and a 3.26x equity multiple. This represents nearly $27 million in profit generated above invested capital. These returns are the direct output of structural mechanics used to assemble and manage the portfolio. Large-scale institutional funds face a specific hurdle. They have massive amounts of capital to deploy, but high-quality industrial assets in land-constrained infill corridors are rarely available in bulk. Institutional capital generally sits idle until it identifies a portfolio with enough scale and operational history to justify the cost of the transaction. This $60 million acquisition is a case study in providing that scale to a buyer that needs to deploy capital efficiently. The process began with acquiring 8 separate properties, using strict underwriting to secure them at a total basis of $33.1 million. This represents the assembly premium. Linking these isolated assets into a single operational platform increases collective value. JPMorgan is paying for the time and effort spent aggregating these properties, a process often too slow and high friction for massive funds to execute internally. Recognizing the difficulty of this assembly, JPMorgan moved their pricing above typical market rates to secure the entire platform. The assembly premium proves that aggregating properties into a cohesive unit creates a layer of value that individual transactions cannot match. This unified structure also allows for operational savings that are unavailable when selling assets one by one. Consider the impact on brokerage fees. A standard 6% commission on these properties would cost $3.6 million. Because we moved them as a single portfolio, the commission was negotiated to $510,000. This saved $3 million, sending that capital directly back to the partners. Structural cohesion attracts institutional buyers, while increasing net profit by reducing the friction of the sale. The remaining closings for this portfolio will occur on a rolling basis through February 2026. We have already redeployed proceeds from the first 3 assets into our pipeline, including the recent acquisition of Murphy Business Park. Our 1031 exchange strategy gives us until the end of March 2026 to identify replacement properties that fit our criteria. If we cannot find assets that meet our underwriting standards within that timeframe, we will return the excess cash to partners, rather than lowering our standards to complete a trade. Maintaining this level of liquidity depends on a repeatable process of disciplined assembly, a standard that defines how we managed these 8 assets and how we are evaluating the next.